The US budget, the Indian budget is a week old, and the United States Fed moves are being very closely watched. Amidst all of this, the Reserve Bank of India, the Monetary Policy Committee, is going to announce its latest move on interest rates tomorrow. And joining me to discuss that, Indranil Pan, Chief Economist at Yes Bank, and Anand Adhikari, the Managing Editor at Business Today magazine. Welcome to Easynomics. Indranil, I'm starting with you. With the bigger plans of the government now clear and visible to the Reserve Bank of India, and the United States thinking as far as monetary policy is concerned also clear, what sort of considerations is the RBI grappling with, the MPC grappling with, as it decides the future course of monetary policy?
I think there are lots of moving pieces, but starting from the budget, I think the comfort that the RBI can draw from the budget is that it is definitely not inflationary. It has definitely shown a consolidation towards the 5.9, which is a 0.5% lower than where they are likely to be ending in this financial year. Having said that, I think you rightly pointed out that the global interest rate conditions are being watched because to a large extent, the differential in terms of the domestic policies, the interest rates here vis-a-vis the external interest rates will also to a large extent determine the type of flows that India can expect. And flows are important if we have to find adequate money for our own development needs. On the inflation side, I think the RBI is now pretty clear about the fact that they are watching the core inflation. And very interestingly, even the Fed and more or less everybody is sort of hawk-eyed on the core inflation within their own countries. And that's something that will possibly be taken into consideration by the Reserve Bank of India.
Anand, the future course of monetary policy, the need to support growth as well as control inflation. What's the choice, according to you, that the policymakers are discussing?
So Siddharth, I expect, one last hike, maybe 25 basis point in the tomorrow's, policy. So the repo rate will go up, from 6.5 to 5 to 6.50. I think the big issue, Siddharth, is going to be, maintaining the current stance of, withdrawal of accommodation. Now, if you see the last policy, two of the members, Asima Goel voted against, maintaining the stance of, this withdrawal of accommodation. And similarly, Jayant Verma too also voted against, maintaining the stance of withdrawal of accommodation. So I guess, that is going to be a big issue tomorrow, whether, the others member will also join, Asima Goel and Jayant Verma.
Indranil, the bit about inflation and how it has performed in the recent period, and yet you have yourself in our last discussion together pointed towards sticky core inflation. From the last time that we spoke to now, have things changed? What could you tell our viewers?
Well, I think the two consecutive months of drop in inflation was definitely the seasonal effect, the winter crops coming into the market. And that's possibly the reason, that was the reason why vegetable prices actually came down for quite sharply. And that led to the drop in the inflation to the 5.72%. Now, having said that, if I track the sort of the advanced numbers out of the mandi, the vegetable prices have definitely moved higher in January. Cereals appeared to be sticky. Lots of other commodities, including fish, meat, and egg, those are also looking to be slightly on the stickier side, on the higher side. And our own estimates for inflation for the January reading, which the RBI obviously will not see before they announce the policy, but they will have some inclinations of this on the same, is looking once again above than the 6% threshold level. So there I think there is possibly no chance of the RBI letting its guard down on the inflation. As you rightly said, the core remains a concern. so is in the rest of the world. And if food prices normalize from the couple of drops, a couple of months of drops that we just saw, that also will lend to a stickiness not in the core alone, but also to the headline inflation. And these are something that would be taken into consideration while they will determine what to do in tomorrow's policy, which we expect a 25 basis points increase. And we also sort of indicate in our analytical piece that the change in stance is possibly not likely immediately.
Anand, in the past and the 225 basis points increase that we have seen since last April, one of the factors, and RBI decision makers have also alluded to this, is how US interest rates are moving and its subsequent impact on the Indian currency. How much of an issue is that at this point of time?
So Siddharth, the differential, between the Indian rate and the US rate, I think is around 165 basis point. And if you see historically, that was around 200 to 300 basis point. So to that extent, tomorrow, if we can, I have my doubts whether we'll get the kind of funds we were getting, earlier. So that will have an impact, on the funds, especially the FI funds which comes into the debt market and the equity market. So a lower differential, that is a very negative for us.
Indranil, that same question to you, and picking up on the point that Anand pointed about the differential.
Yeah, so looking at it slightly differently, I would argue from the perspective of the 10-year yield. And now the 10-year yield broadly averages in the good times at around 500, 525 basis points. We saw that 10-year the differential having dropped to about 340, 350. Now it is around 360, 370, which is still much lower than even the one standard deviation around the mean of 550 that I talked about. On top of that, we have the budget, which possibly is slightly sort of negative in terms of flows, because what I think we are looking at is the withholding tax of the FPIs rising from a 5% back to a 20% level. So that could be negative in terms of flows. So there are two factors to flows. One is the push, which is basically the interest rate differential. And the other is the pull, which is basically the growth and how much of an FPI or an FDI sort of comes into the economy. Even for that matter, the external commercial borrowing and short-term borrowings of the domestic importers and the exporters. So given that interest rate differential is low and that the global liquidity is gradually getting withdrawn, these are some of the factors that we need to look at from a flows perspective into India.
And so just to add this, the current account deficit part, the CAD part, now we are seeing a current account deficit of around 3%, and with export not rising, as fast as we are seeing the imports rising, and with global recession, I'm sure the export basket will get impacted. So there is a threat, with elevated US interest rate, lower differential, and then the impact coming through the currency due to India. Even if suppose, let's say, oil and the commodity price remains the same, but if the currency depreciate, then maybe we have a threat of, inflation through the currency.
Indranil, what's your own sort of reading of how the rupee is likely to perform, at least over the next a quarter, if not beyond that?
Rarely have we seen large depreciations in 2 consecutive years. Last year, of course, we had a significantly large depreciation compared to historical standards, except for the 2008 and the 2013 period. So if the depreciation was to the tune of about, say, 7.5%, 8% in the last calendar year, we are expecting a 3.5% to 4% depreciation in the current year. And that should be more an orderly phenomena. In the sense that we are all reaching the end of the interest rate cycle not only domestically but also globally, that will likely provide a slight bit better clarity in terms of what interest rate differential and how growths are overall in the global arena, and therefore what are the implications of that for an emerging market economy and the currencies of India. The black box, of course, remains China, which I think we don't have an extreme clarity. But having said that, I think the structural impediments of China's growth remain relevant. And therefore, I would expect CNY to depreciate from the current levels, which should also lead to some amount of currency depreciation in India.
Indranil, before I go to Anand and ask him about RBI governor's own personal views on growth, the RBI governor was at a Business Today banking conclave just around 2-3 weeks ago with us, and he offered great insights into this. I also want a quick comment about what you said earlier in terms of the inflation cycle globally. And that is obviously of great importance to us as well. Expand on that in terms of how you see advanced economies inflation panning out.
Okay, so I think definitely inflation has turned the curve. It is coming down, but the fear is that the inflation might not come down as fast as the central banks had earlier expected, and also would be still away from the 2% implicit target that most of the advanced economies follow. But the very recent data from the US was obviously the payroll data, which showed a significant upside at about 576K addition to the payroll. And that's not all. The wage growth continued to be steady at around 0.3% on a month-on-month basis, and the unemployment rate dropped further. Therefore, raising fears that there could be some channel effects of the labor market tightness onto wage growth and therefore inflation. So these are some of the factors that around which there are significant uncertainties. And if the currency depreciation also is relevant for emerging market economies, that could be one more channel for inflation in India. The core in India remains sticky, and therefore we are not really looking at anywhere the 4% target of the RBI to be met in 2023. That could be still a little way off. Our average inflation for the next financial year is looking at a 5.2 to 5.3%.
Okay, 5.2 to 5.3%. Anand, on that broader question, and while the MPC likes to do things by consensus, the RBI governor's voice and views also carry very significant weight during the deliberations. When he was last with us, he had offered a detailed explanation on the growth versus inflation fight, the impossible trinity. From your recollection of that, where does his gut instinct lie after what is a fairly straightforward budget that Nirmala Sitharaman has delivered?
So, last time when he met us, I think that time the projection, the RBI's projection for the Q1, 2024 was like 7.1 and, 5.9 was for the Q2. The big change, Siddharth, I see post-budget, there's a big, preference for, like capex, if you see, whether we have seen the private capex is not picking up, but revenue expenditure is the one, we have seen hasn't grown much, and most of the government expenditure, 80% of the government expenditure is revenue expenditure. So a big hit on the consumption side, I see, from the government, and if I look at, 23-24, elevated interest rate, the full impact of interest rate will come by 2024, elevated inflation, which is close to, even if I see the next 2 quarters, the 5.4 projection by RBI by September 24 is also very close to the targeted 6% level. So very high inflation, a high interest rate. Government's focus not much on the consumption side, more on the capex side. I'm sure there will be some hit on the growth. This is my assessment.
Indranil, is the government through the capex spending, which is obviously medium to long term in terms of it actually translating into activities on the ground. And I am sure a lot of our viewers also know that if a project is agreed upon and the initial 20%, 30% or whatever the payment terms may be dispersed in one financial year, the payments are usually milestone linked for large infrastructure projects. Therefore, would it be a correct way to interpret the government's budgetary moves that they don't want to do anything inflationary? Instead, they have chosen medium term, long term projects which will eventually deliver growth. Is that also a way to look at the budget?
I think the heart and soul of the budget continues to be looking at the long-term growth, and that's very clear in the messaging from the Honorable Finance Minister. Therefore, the standard prescriptions in terms of reforms trying to go down to the last mile, inclusive growth, those are certain things that are being highlighted in the budget. The critical issue for me, however, is the amount that the central government capital expenditures has carved out for the state governments. Now, for the current financial year, the carve out was about a 1 trillion rupee, and the revised estimate shows an achievement of about 76% of that. And if you actually look at the economic survey and the chapter on the fiscal in the economic survey, the amount of money that has actually gone from the central government to the state governments is even lower than the 76% that I talked of. Now, for the next year, the budget has announced a 1.3 trillion of pass-through as a 50-year loan from the central budget to the states. And therefore, my critical issue is the implementation of the capital expenditure at the state level. The central capital expenditure is relatively easy because this is more roads, transport sector, and the railways. The state capital expenditure is something where the challenges lie in terms of maybe a land acquisition, in terms of financial closures, and various other approvals that need to be taken. And therefore, a critical handholding is essential between the center and the state government to clear off the last mile impediments that could be there.
Anand, beyond the monetary policy decisions, the RBI governor also talks about other things. Is there anything else that is expected beyond interest rate policy that we should look forward to?
It will be more regulatory, the issues. So I don't know, maybe something, on UPI, like last time we saw, this linking of RuPay card, with the UPI. So yes, maybe there will be some, regulatory issues that we will, tackle.
Okay. Indranil, that same question to you. Anything else you are looking forward to that the RBI may choose to talk about?
I would probably personally try to look at the guidance, especially for the next year in terms of the liquidity side story. The importance of that is because the central government borrowings have increased. The states, as per our estimation, is also likely to borrow 7.5 to 8 trillion through the SDLs, which necessarily means that there is almost a 23 trillion sort of borrowings that the central government and the state governments together would need to complete. And therefore, the some sort of a direction in terms of how the RBI is looking at liquidity and managing it, especially in an atmosphere where we are talking about lower dollar and global inflows, becomes relevant for me, and I would be critically looking at that, if not in the Fed policy, but definitely in the April policy.
And just to add, Siddharth, on the borrowing part, I was just looking at the budget, this 12.30, market borrowing, which is budgeted for, 23-24. Now, if you see the last 2 years, there was surplus liquidity, rates were low, bank credit was not growing. So that in a way was easy to, I would say, to raise, maybe 12 lakh crore, or, in FY22, around 8 or 8 to 8.5 lakh crore. But now with interest rates going up, monetary tightening, and the credit is also growing. I mean, that's a difficult task for RBI now to manage the government borrowing of around 12 to 13 lakh crore in 23-24.
All right. Significant announcement expected from the MPC, and whether it chooses to do a 25 basis points hike, pretty much the consensus view. And if that is going to be the last in the present cycle is the key commentary that all of us will be looking forward to from the Monetary Policy Committee. We'll be back with that tomorrow at the moment of its announcement, as well as analysis through the day. Do stay tuned into Business Today Television. I'm thanking my guests once again for their time with us today. Goodbye.